Okay, welcome back from that break. We will be getting started here on page 316. This is the power play section or velocity play, one of my favorites. This section should last about 40 minutes or so, 45 minutes maybe, and then we'll have another 5-minute break at that time. As a quick reminder, we will have today's replay at 6 p.m. Eastern time tonight, and do use the same login credentials for each section, replays or the morning, as well as for the live trading day. So with that said, let's get back to Mark and Mark.
Okay, welcome back. We discussed the magnitude opportunity or magnitude play, as we call them, which is the primary base. That's the first chance that you get to buy a stock after it makes an IPO, or the first buyable base. So I talked about two opportunities that were really important for you to focus on. One was the magnitude play, and the other one was what we call the velocity opportunity, or the velocity play. And that's the power play, or this is essentially a high tight flag that you can read about in my books. And also O'Neill talks about this, not at, I think, as much detail. But again, let's first define what needs to be met. And I also want to welcome Mark back.
Glad to be back. This is a great section, obviously one that's near and dear to my heart.
Exactly. That's what I was just about to say, that Mark has played a number of power plays, his fair share of power plays, and also has some things that he's learned over the years that he's going to share about power plays. So first, let's define the definition, or what the criteria that needs to be met to be even considered as a power play, because like the stage analysis, where we want to be in a stage 2 uptrend, the power play has some criteria too. That's a qualifier, where it needs to meet certain criteria to be even considered a power play. And one of the things that we're going to change a little bit when we look at power plays is, number one, the bases are going to tend to be a lot smaller. They're going to be anywhere between 10 or 12 days to as much as 3 to 6 weeks. The other thing is that with the stage 2 uptrend, with power plays, sometimes they come from a very dormant period where they're in the stage 1, or they haven't moved for a long period of time, and then they just explode. So what happens is you don't give the 200-day moving average, or the price, to get above the 200-day moving average and to get into an uptrend for very long. And that's one of the reasons why I came up with the 1-month template that's on MarketSmith, where you can run the 1-month screen, and that'll pick up a lot of power plays. As a matter of fact, David Ryan said that he always runs the 1 month. He likes to run the 1 month in addition to the 5-month. So again, you don't have to be in a confirmed stage 2 uptrend where the 200-day is up for 4 or 5 months when it comes to a power play. So the first criteria that needs to be met is that you want to see an explosive price action where the stock moves up 100% or greater in 8 weeks or less. And if it's 95%, that's probably close enough. I've traded them that are 90, 95%, but very close to 100% or greater. The more it moves up, the better, and in the shorter time frame, it's better. So the quicker that it happens, the more explosively that it happens. Also, I also would rank them higher, I guess, if you want to call it, if it came from a period of where there was really nothing happening in the stock, and then all of a sudden it just exploded out of nowhere. Now this can come up, this explosion in price over these 8 weeks or less and sometimes it's just a couple of days, can come on news. It could be an earnings report. It could be an FDA approval of a drug, some key contract that the company just got, or sometimes it's a resolution of litigation, but very often it's on no news at all, which I call unexplained strength. And I actually like those. I like the fact that when there's no real apparent news, what happens with those situations is what it means is that most of the movement in the stock is institutions, those that are pretty close to the company because it hasn't really hit the news. The news hasn't proliferated where you got a lot of those retail hands in it. So those I tend to favor just as much as if it was on an earnings report. Now, could be a drug company and there are no earnings, like I said before, about biotechs and so forth. But then once you meet this criteria, the stock's then going to move sideways, and very often it'll go through the most of the time you'll have some type of volatility contraction, just as you would see with the larger bases. And then sometimes it's so tight where it's just 8 or 10%. It doesn't need to really contract much because it's already tight enough. But this will happen, like I said, over a number of 10 to 12 days, as much as 3 to 6 weeks. So what I want to do is I want to show you, a bunch of these, so you get the what the chart looks like, and then also talk about some of the caveats and some of the things that we've learned about power plays and the best way to play them. Now, the reason why we call these velocity plays is because, first of all, they come from a period of or a burst in velocity. You have a very sharp move up, and the velocity begets velocity. So these can move up very quickly in a short period of time. As a matter of fact, when we look back and we see the more successful ones, from beginning to end of the trade, you can get anywhere between 1%, 2%, 3% a day to even more. Some move up 8 or 10% a day over a period of 10, 20 days. And when you look back over maybe 50 or 60 days, very often you'll see that these trades deliver anywhere between 1% and 3% a day on average. What I've seen, my anecdotal evidence and some of our scientific studies show that about 2% a day on average, but it does vary. I'm going to show you a bunch of these in just a second here. So Best Buy was one that I bought back in the 90s, and one of the reasons why I like to look at this particular, or study this particular chart, is because I bought it perfectly on the right day. You can see the volume came way down. It was right around Christmas time, so that would make sense. But then the volume came in real strong here on the breakout. This stock went up almost 1,000% in under 20 months. One of the reasons why I like to look at it is because I traded it, I made some good money in it, but I didn't make 1,000%. So I probably could have handled it better. Mark, I know we're going to get into this a little bit more later on, but why don't you just real quick talk about why is it that, or what you found about your own trading and when you studied the power plays, about holding them a bit longer sometimes than we might normally hold on a trade, on a swing trade.
Sure. Excuse me. The key to remember with these, is that the price action should be speaking to you, and the more you do this, sometimes these charts just have a way of jumping out at you. But, when something is that explosive, and, to the prior slide, it's not just that it has had this big move, it's that it's not giving much of it back. We'll get into more of that, but it just should be sticking out to you. And that strength is just telling you that something is going on in the name. And so, as Mark was saying, like, these are that velocity type play. So you want to give them the benefit of the doubt. And it was, I think, after my, third or fifth master trader program, I just decided to go back and do a study of every power play I'd traded. And I noticed that I was consistently selling them too early, the ones that were working. And so the rule I kind of came up with was the idea that, okay, if my average loss, and for me, my average loss is around, say, 4 or 5%, instead of, say, going for a 2-to-1 on these type of situations, I double it, generally speaking. So when things are working, meaning the stock breaks out, it gets follow through, per one of the earlier sections, you see those good volume days, majority of up closes versus down, that I don't want to just sell the stock at, say, an average gain. I want to go for more. And then the other thing is not to choke them off. So those were sort of the two big takeaways for me. And again, this wasn't just, I didn't just cherry pick a few. I looked at every single power play I traded, and came up with these rules because these are so powerful, i.e. aptly named, that you just want to try and give at least a piece the benefit of the doubt. So what I generally do is I will sell a piece at, say, a 4 to 5 R, and then I try and hold a piece for at least 20 days, because to Mark's prior point, if the best ones go, say, on average 2% a day, at 20 days, that you're looking at a very meaningful gain.
Yeah. And so again, giving it the benefit of the doubt of really, matter of fact, whenever we see these set up, even if there's no earnings, there's no news, it's unexplained strength, I almost always buy some position. As a matter of fact, if you look right here, it was actually setting up right here, but I didn't see it there. I didn't pick it up until over here for whatever reason. I don't remember. It was a long time ago, but my screening, I picked it up over here, and same thing happened with Taser, which I'll show you in just a second. There was a bunch of setups, I think, a couple times.
Just to add to this one example too, Mark, if you look, that's the line of the S&P. This stock goes from 1250 to 30, while the market just goes sideways.
Yeah, again,
that is screaming at you. This is in its own world. This stock is marching to the beat of its own drummer. Something is going on here.
Yeah, here's taking a look at the stock exploding here and the market moving sideways here. As a matter of fact, it went up even further. All this time, the market is moving sideways. So incredible alpha. We're always looking for that alpha. We're always looking for the alpha to deliver alpha. We start off with alpha. We want to see relative strength, and then from there, like I said, strength begets strength. If you do your homework properly and you're in the stocks that are under accumulation. So let me show you a couple of these, and then we're going to come back to some of the things that Mark discovered, some additional things that he's contributed to our observations of the power plays. So with Quality Systems, in 1996, I bought this stock coming out, and again, you can apply that same acronym or the same abbreviation, if you will, 4-week 25 by 5 3T. So this came off a little bit more than the 20%. And I can't remember if there's a lower price stock, but sometimes if the stock's a lower price stock, this is adjusted for split, so I don't know what the price was at that time. But sometimes when you have a stock that's a lower price, it might be 10 or 12 bucks. I'll give it a little bit more. That's one of the caveats. With a lower price, they could be a little bit more volatile. Once you get over the mid 20, 22, 23, maybe 25%, you start going near 30%, it's really starting to be a bit too excessive on the correction. And real quick, Mark, let's also talk about, why do we want such a shallow correction, or why is it so important and telling that, after 100% move, that the correction is shallow? What is that telling us?
Yeah, there's no profit taking. And to me, this is actually more important. If there's a more important piece of the analysis in properly identifying this, it's easy to spot a double in a short period of time generally. But where people tend to make the mistake is they point out stocks that have pulled back 50% after having a 200% run. We want to see that strength that is abnormally maintaining its move, meaning there's no sellers. And if you think of it, logically, if there's weak and strong hands, to our point from prior sections, all the weak hands are being bought out. So as this is having this explosive move, the institutions clearly don't have enough shares yet. That's why it is just sort of moving sideways relative to its move. It is having this high alpha, low standard deviation, which is telling you the institutions are not selling.
I'd imagine a stock goes up 100% in just a number of days or weeks, and it doesn't correct very much. That means that there's either a lack of supply, or the demand is really is absorbing all that supply. And that's exactly what we're looking for. We want to see a stock that the strong hands are really in control. So the fact that it can only pull back 15, 20% after this meteoric rise is very telling. And then as it tightens up and that supply even diminishes even more, that's where they become very explosive.
Just to add too, Mark, if you think about, you mentioned how you ideally want to see these coming out of that period of dormancy. And we've sort of noticed this over the years, that those ones that all of a sudden the stock maybe has been going nowhere for years, and then it just explodes higher. Well, if you think to our point earlier about how the institutions, they can't move as fast as everybody else. So they're the ones that are creating something is changing in the name, in the stock. We may not even know what it is yet, to your point earlier. Sometimes it's unexplained strength, but the institutions they are piling into this name now anew as things are changing. We get a chance to identify that they're not potentially done buying. that's really what we're looking for, is to say, you know, if the strength is holding, it means if more demand comes in and there's little supply, prices can move higher and rapidly in these particular setups.
So in the case of Quality Systems, a couple things. First of all, it had accelerating earnings. So you can see from negative earnings to 150% EPS, then it went to 177% EPS. So really strong earnings. And it went from almost trading by appointment. You can see all these gaps in this very sparse trading right here. This is a very thin trading stock, to all of a sudden it's trading millions of shares. And so that's a big volume clue right there. And that tells you that there's interest here. There's big money interest. And now, of course, the lack of volatility. And if you look up here, 126% in 66 days. So again, that's a great return in a very short period of time. That comes out to about 2% a day. Let's take a look at another one, Taser. So this is one that again, it meets all the criteria. It met the criteria down here. There was a little base right here, right here. You had a couple already had a couple opportunities. As a matter of fact, by the time I bought this stock, it had already moved up, I believe 12-fold. So again, it looks like it's high. The PE was 250 or some odd, times earnings. I think we pointed this out, of course, in the valuation section. But I bought it coming out here, and it was a ripper. I made 160% on this in a very short period of time, and it went up 329% in just 16 weeks. This one a little more recent. This is one that Mark and I both were buying back in 2020. You can see how it gets very, very tight, doesn't correct very much, has a big move here. It comes up from just a $2 or $3 stock and goes up to almost $10 and then tightens up very nicely. Again, you take a look here, 81% in 26 days. This is almost 4% a day. So again, giving you that real quick bang for your buck. BVXV. This is one that just took off like a rocket. I actually sold this too soon. I didn't stick to Mark's rules of giving a little extra time, and it just blasted off. Now, again, we want to make sure you understand also that something like this, we'll talk about this in the selling section and selling rules. This was a pretty big sell signal, this big wide bar here after it got very extended. So this went up 150% in just 6 days. That's a 20-something% a day profit. So this in this type of situation, we would certainly be taking some off the table into that. So it's not a hard, fast rule that you should hold this for 20 days, 30 days, 50 days, or not sell it if you get a really big gain in a short period of time. You still got to look for sell signals or sell rules, but we'll get to that later. So BEEM, this is one that we added to our buy alert list for our clients, but I did not buy it. So whenever I spot something and it turns out to be a really great stock that I didn't buy or I missed, I always try to study it and see why I may have stayed away from it or what was missing at the time. Sometimes it's a little deep in the correction, the first T, if you will, and I'll stay away from. Sometimes the market just happens to be, I'm not doing very good in my trading at that time, and I'm taking it easy, so I pass on a few names. It really depends, and that's going to vary from person to person. But this, again, just a ripper, just coming out of here, showing the power. VAPO, you remember this one, Mark? This is one that actually Mark, I believe, brought to me at the time over here. And one of the things I want to point out is you can see that it is not yet in a stage 2 uptrend. As a matter of fact, the 200-day is still moving down a bit here and hasn't even started turning up. So this was really early, and this kind of didn't really hit my radar, but Mark picked this up, and we bought this coming out here, and then there was a follow-up buy point. I actually sold right into this first move. Then he set up a follow-up buy point, and I know, Mark, we were both sort of kicking ourselves that we didn't add it back there at that follow-up buy point, right?
Yeah, and I remember that one well, because that it was actually the follow-up buy point was almost an easier buy. You just see how it just exploded out of both pivots. But yeah, this is a good example of sort of one of the few times where when something's this explosive, the long-term average doesn't have enough time to turn yet. And this is one of the sort of caveats where I will occasionally trade a situation where we're not in that stage 2 yet, but you can tell if this power play is going to work, it's going to be in a stage 2. And there have been situations where, and I know you as well, where we'll trade a power play if it's an early turn, and then the stock, we might trade out of it. Then the stock sets up a base, and we trade it again. Where that power play is what puts it in the stage 2. So this is sort of one of these times where it gives you an entry technique, or again, to potentially show you that this stock is going to be under institutional accumulation going forward.
And that's exactly what took place here. And you can see after you got that setup, once the trend started turning up, now you're turning up into that stage 2. Look how efficient and how nice this move was. You got all this alpha. Another thing to pay attention to is this was coming right off of the bear market right here. There's your bear market low. And then this is one of the very first stocks right off the low. This stock is going into new high ground here at 2038, right off the low. So that would have really stuck out like a sore thumb. Also, if you were just looking at the high relative strength stocks, the stocks that were their RS lines were going to new highs. Like right here, you can see the RS line right under the price. 140% in 14 weeks, 170%. I'm sorry, in 14 weeks. The other thing too to remember, or to one of our goals, and what your goals should be if you want to make best use of your capital and compound, what we're trying to do is find where momentum is the strongest. And that almost never happens early in the trend. You've heard me say you want the right price, not the lowest price. The right price is where momentum is the strongest. And while you may pick the low or buy it earlier, if it's moving sideways or it's volatile and it takes a long time to make a move, well, then you're losing that time value. So here, when you come into a stock like right here, and within a number of days, you're up 15, 20, 30%, and you make, you're up 100% in just a matter of weeks or months. Now you're making not only really efficient use of your capital, but you're compounding at a huge rate. So that's the goal. And these are some of the best plays to accomplish that. So here's another one where I remember we put this as a potential buy on our own platform for our members, 70% in 55 days. So again, a pretty big per day return, if you will. And I did not buy this. One of the reasons is that the peak to trough drawdown here was, if you see 14 down to 11, that's a pretty big decline. But what I did was I cut it a bit of slack, because you can see it closed. The close was actually right here. It was only 1 day. It traded down there and it had a great close. So that's sort of one of those situations where you make a judgment call. If it's just one quick day and it recovers really quick and gets real tight, you could maybe give this one, I don't remember what was happening at the time. But again, this is one you might want to cut a little bit of slack, and maybe position size a bit smaller, just because it's a bit more volatile. But the volatility really quieted down. Also, the volume didn't come way down. It was still, when I saw this volatility and then it still had a lot of volume, it felt like there was still supply there, and it didn't really get to the point where it significantly dried up. So that's another reason why I probably stayed away from it. Now again, SPCE, which is Virgin Galactic, Richard Branson, who's one of my all-time heroes. Another stock that baffles me why I didn't play it myself. I actually did not buy this, and we added it 2 consecutive days. We added it to our buy alert list, and then it came out and just bang, big quick move. Again, this all happens in a matter of, this stock more than doubles in 1, 2, 3, 4, 5, 6 in 7 days. So, incredible use of your capital. I just want to go back here for a second and go back to what Mark was saying, and to recap. Why do we want a shallow correction once the stock makes this big move? We talked about why we want a shallow correction, is because that shows that there's the stock is very strong. There's very little selling or supply coming to market. Even after such a big gain, you would think after a 100-200% gain, there'd be tons of profit taking, but the stock doesn't correct very much. So that's speaking very loud. That's saying that there's a lack of sellers, that nobody wants to give up their shares, and that there's a tremendous amount of demand for any shares that are for sale. They're being sucked up by the stronger hands. As Mark said, why hold longer? Why give it the benefit of the doubt and try to hold it for a bigger move? Now, if the stock just blast off and it's up 150% in 6 days and has, huge gaps. And yeah, you're going to want to take that. That's a gift horse that you're not going to want to look in the face. However, maybe it's just, inching its way up, and it's 15, 20 days later and you're up 20, 30%, and it hasn't really accelerated yet. Very often these will accelerate at some point and you want to sell into that accelerated advance. So you might have to wait longer. You want to give them some more time, and at least with maybe part of the position. So you maybe sell half the position at where you normally be taking profits, and then backstop the rest and sort of trail it up. 1 to 3%. You saw some of these delivered 8, 10% a day, over 6, 10, 15 days. So what I've seen is that usually the ones that work out at a minimum, you're delivering 1% a day, which again is a really huge return on your capital. And the other thing, did you talk about choking it off too quick? I'm not sure if we got to that yet.
Just briefly, but I didn't give one of the observations I had, again, from my own trading, not making cherry picking examples, was that there were a few times where I had tightened some stops up on a stock that, maybe it was up a few percent and then came back to even, or that kind of thing. And then the name blasted off, and I was, again, on the launching pad watching the rocket, go upward. And I just did some basic math to say, okay, with whatever this saved me in terms of choking it off, was it worth it? Meaning, if the stock doubles, is it worth it to save an extra 1 to 2% in choking off your trade? Well, the answer is obviously not. And again, because these situations are so powerful, I've just found, just let them stop you out and give them the benefit of the doubt, both in terms of the existing position as well as the stop loss.
Yeah, and just real quick, something like, when you have this kind of upside right here, I'm just going to draw some things in here. You have this kind of upside, and you're setting your stop. Let's just say, it's not, now, of course, they're not all going to have that type of upside, but let's just say, you have this type of stop set. That's your stop loss down here. You want to create that asymmetric leverage. And if you start moving your stop up too quick, and you choke the trade off, well, you're not giving it that opportunity. So because they have such big upside in such a short period of time, you're increasing not only your upside but your time, your cost, your opportunity cost, that you want to try to give it that stop, and come up with an amount that you want, you're okay with losing, and try to stick with it until you get at a pretty decent gain, and then you'd see some violations kicking in. If it reversed at all, maybe you move your stop to break even. Let me go forward here. So I'm just going to go back to pharmacyclics. We showed this before, but again, a lot of these will come right off the market low. It's like we just showed that previous example where it came right off the COVID bear market low, right off the low, ripping off the low. I sometimes prior to it setting up, where you'll rip off the low and then it'll achieve that 100% gain, and sometimes it previous to the low, when the market's doing poorly, these will just come out of nowhere and they'll rip higher, and then they'll set up, and then as the market comes off the bear market lows or the correction lows, that's where it'll break out. Now, another reason this chart is, again, to show that you had 100% in 48 days, and that's a great return. But over the next 43 months, it went up 2,600%, and then even further than that, this ended up going private, and it was much, much higher. So again, once you get at that profit, if you can put yourself in a position to free roll, these could turn out to be some really amazing opportunities for you. Again, here's another one where this is just recently. And again, the market has been really kind of crappy, going forward here from this particular point. We added this to our focus list just back in September, and the market actually went and, has been flirting with the lows and hasn't gotten anywhere. And you can see AKRO here, has ripped quite nicely higher and made a pretty big gain, even when the market's done nothing. Here's another one. I'm just going to show you a bunch of examples because I want you to see what these look like and have us discuss the nuances, so you really get an idea of not only what to look for, but how to manage these. Sometimes this is one that I actually bought and I sold the same day. It just ripped higher. I mean, this just made such a big move. I remember I can't remember if it was 20 or 30%. I sold it, and then it went even higher. That intraday ended up closing off the highs, but sometimes you get, these one-hit wonders. Now, the same characteristics are going to apply. Again, I'm going to repeat myself again. Remember before I said everything that I tell you prior, it all is built upon, whoops, so everything prior that we discussed, we're building upon. So nothing negates it. And if there's any caveats, like in this particular instance, there is a caveat. Okay, we don't necessarily have to be in a confirmed stage 2 uptrend where the trend is up for the 200 days in an uptrend for 4 or 5 months. So we can use an early turn because these are very explosive. If they come from a period of dormancy, they'll move so fast, they don't give the longer term moving averages a chance to turn up and get into that uptrend. But the same exact characteristics. You can see right here, you have that little pattern right there. There's a little BCP. And sure enough, the volume comes down right in that tight period. See, even when you look at these at a micro level, you look at them intraday, you look at them on a weekly, you look at them on a daily, on shorter time frames, longer time frames, the same characteristics, the same footprint just keeps repeating over and over and over prior to explosive action. See, because it's not a coincidence. It's the law of supply and demand. It's that supply not coming to market in a stock that has big demand, and now the lack of supply, the big demand creates explosive potential. Take a look here at Arena Pharmaceuticals again, and sometimes you get where you'll get little cheat areas and low cheat, and then you'll get a handle phase. Same thing. You look at this big base that formed here, big for a power play, if you will. But you see the volume comes down in those tight areas, just perfect, right on schedule. This goes up 96% in 14 days. I mean, how'd you like to have a couple of those? Even 1 or 2 of those a year could really enhance your performance. Here's a more recent one, 52% in just 4 days, just came ripping out here. Now, again, you can come off of the low cheats, even though these are smaller chart patterns, you can still get a low cheat. Sometimes you'll get a low cheat, a cheat, and a handle, and you'll get multiple contractions within the base, and you'll get opportunities. Very often, Mark and I will be buying up. If we get a low cheat or something really low in the base, just coming off the lows, if it comes off 20%, sets up off the lows like this one did here, we'll take a part of our position. And then if it can improve and keep tightening up and setting pivots, we'll just keep adding as those pivots develop and build our position. Then when the stock finally comes out, we've got an average price somewhere in between, right in the middle of the base. We got a really nice average price, 200% in 90 days. This is another one where I bought perfectly, and I actually sold it way too soon. I sold it up to this first move and did not capitalize as much as I should have. MFLX, you see it forms that little low cheat, just like a larger pattern. Same exact characteristics. Here's one that I don't know if Mark, if you played Shutterfly, this was a little creative on my part, where it only paused for 1 day coming off the lows. This is almost like bottom fishing it, but you had a power play from a little mini, very micro low cheat, but worked perfectly, 40% in 8 weeks. Another little low cheat right here, and then it's set up again. You had a couple points to buy this. Now, here's the other thing to consider. We talked about the primary base, right? The magnitude opportunity where you get that first viable base after it goes IPO. Well, there's times, I wouldn't say often, but every now and then you'll get a stock that will set up in a primary base, and it'll break out of the primary base, and it will morph into a power play right off the primary base, which is tremendously positive. When you see that, I mean, you might have been buying off the primary base, and maybe you sold it into that strength, but then all of a sudden it forms a power play. You should be definitely adding it back, or if you hadn't sold it, maybe add to your position. And this is the way you can build a position in something that could be a really big performer and make a lot of money in one name. KITE, Kite Pharma, was exactly perfect in how it's set up here. Nice little tight little pivot point, breaks out, and then morphs into a power play. Same thing happened with Adaptus Health. Again, primary base here, breaks out, and now morphs into a power play over here on the right side, goes from 30 to 60 in just a couple months, and then tightens up and comes out here. And from this point right here, it's up 77% in 53 days. Of course, if you bought it down here, you made a really nice move on there. Clearwater paper. This is one that I bought. Uncharacteristic of me to buy a paper stock, a deep cyclical, but this stock was so tight, and just really, really tight. As a matter of fact, this was like 10% or under 10%. You didn't even need any volatility contraction because it was just so incredibly tight. And this leads me to another point where you should always look at a weekly. Anytime you're looking to buy a stock and you're looking at the daily, look at the weekly, because there's also things that in the weekly that characteristics that you will see that you want the weekly to look just as good as the daily. And with the weekly, what we look for, especially in these power plays or when you get into periods we get natural reactions over several weeks, tight closes are very important. They show, once again, this is an indication that there's not a lot of supply. There's not a lot of variation from week to week in price, and it's constructive. It's generally constructive. So you can see here, you've got 1, 2, 3, 4 out of 6 weeks, or 4 out of 5 were tight. 1 week was pretty tight. Only had 1 week really out of that range, really tight. Another one here was Cardtronics. This was back when ID systems were getting politically charged, that everybody was talking about ID systems, and I believe Cardtronics just did an ID system in Italy or something. They had this technology, so the stock came out of this space. I learned about it. It was setting up perfectly in this power play, and in 1 year it went up 100%. You can see pretty tight closes here. You've got 1, 2, 3, 4 out of 5 weeks, very, very tight closes. That came out real nicely. Take a look at ANAB, sorry, dyslexic here. Back in 2017, this is one that I was buying off of that low cheap, but then it stayed really tight. It actually improved, and you had a follow-up buy point, 96% in 4 months. See, look right here, very tight closes. Yeah, all the closes, you had 3 weeks to really tight, and then one was just up a little bit as it started moving through that pivot point. So tight closes. Here you look at ADPT. Whoops, sorry about that. Cut off there. ADPT. Very tight, 77% in 53 days, a little more than 1%, maybe 1.5% a day. Very tight closes here too. Okay. AMD, this is where I first bought AMD in this last big run that AMD has been making since 2016, or actually not right now, but it went on to make a much bigger move even after this 190% move. But coming out of here, the closes were really tight. You had 3 weeks with almost no variation whatsoever. So these are other clues that you can look for confirmation that the stock is setting up properly and it's digesting that move quite nicely. And when you get that low variation, the shallow pullback, the tightness, the VCP, and you have tight closes in the weekly, that's telling you that there's a lot of strong hands in that stock. And if there are any weak hands, they're being gobbled up by the strong hands. One last thing here, and then we're going to take just a short break, and then we're going to come back and talk about squats and reversal recoveries. But I want you to look at these two charts here. I traded Emulex back in 2001, and it just blasted off to the moon. I made a nice rip on that, and that was in a tough environment. That was after the market had rolled over into a bear market. I was actually short the market at the time, but this stock set up in this power play, and I decided to play it. If you take a look at this and you compare it to this other name that set up in 2013, which I did. I don't remember trading this. I think this is one that I just used as an example because they were so similar. I tend to have when it comes to stock charts, I tend to have sort of a photographic memory, or at least have a kind of a Rolodex where I can remember precedents. When I see a stock, I say, oh, that looked like this name. And I remember seeing this later on in 2013, thinking, you know what, this looks just like Emulex. And sure enough, I mean, you'll take a look at these two setups right here. Even the weekly, where you have the nice close. This is 5 weeks. This is 4. But you had one inside week here. If you took that one inside week out, it'd literally be identical, absolutely, almost perfectly identical. this is what happens. This just happens over and over and over. And what you need to do is to use this workbook as your starting point for models and to build a model book, and then to start to build your own. As you start to see these charts, when you see stocks that set up in a manner that is constructive, take that and take a picture of that and start building your own model book, and then start comparing them and going back and looking for precedents. You're going to be amazed at how often this repeats, and you're probably going to say, why isn't everybody seeing this? Well, it does take some expertise to recognize it in real time and take advantage of it, and have the nerve to buy it. Sometimes there are markets in a bear market, and these are coming out of these these bases that are up 200%. PE is huge, and as much as we went through all this, you'll still might be scared until you see these for a while, and they start to work for you. So anyway, we're gonna move on now. Let's take just a quick break, and then we're going to talk about squats and reversal recoveries, some more granular, and getting down to a more microscopic view, and really looking at things with a fine-tooth comb here. So we'll take a break, and we'll be right back.
Okay, guys, that is the conclusion of the second session for day 3 of the 2022 Master Trader Program. We actually are going to take a 15-minute break here and give a little bit more time, because we'll have just a short break after Mark mentioned the next section being squats and reversal recoveries. We'll have a short break there, and then we'll get into selling before we conclude the curriculum for the day, and then we'll get started with the question and answer session. So let's take a 15-minute break here, and we'll be back.